What's up everybody? So this is the video I was trying to reveal to my audience that I would be creating a video on my personal model, and I just want you to be patient, and I would be giving you everything. I would reveal everything to you, what I know about the markets, and of course you will be welcoming profitability into your life, in your trading career, right? So this is going to be the London model with including CRT, and we'll be just giving you the step-by-step guide, right? And we'll be just having some of the parts in to that video as we can be going for a step-by-step guide, right? So now content we are going to include would be the part 1, introduction to CRT. So CRT is basically the candle range theory. We'd be discussing on it and how does it work, the psychology behind CRT, high probability CRT key times. And then part 2 would be the SMT divergence. I've created a video on it and you can be watching it, but I would be giving you the overview on SMT divergence for better understanding. And part 3 would be time and price theory, and which is most important topic. Many of you guys have been not focusing on that part of the trading, but it is very important because always you'll be looking for time and then we'll be looking for price, not price and time, right? So time and then price, which is very important, right? And in that phase we'll be going for time and price theory, number 2 PDRA metrics, and number 3 entry models, which is very important in it. And then at last we will be putting it all together. I would be sharing you the examples, given examples, which would be the deeply examples live on charts. Okay, so now part 1, introduction to CRT, candle range theory, introduction to CRT. So now what is basically CRT? CRT stands for candle range theory, that each and every candle is a range. The candlestick CRT typically refers to a 3 candle sequence on the high time frame. So if you're looking for this theories, just leave it. Okay, now if you're looking for this pattern on the chart, right, on the example, so this pattern basically is the CRT low, candle range low and candle range high. So we'll be looking for a specific time based candles or 4-hour candles for CRL and CRH, candle range low and candle range high, when market is actually taking out the low according to the buys, and then we'll be looking for the bullishness into the markets and we'll be taking buy positions here till CRH, right? So how to identify CRT? We'll be having some of the important times in our mind. Look for around key levels and note some of the important time windows. As for London model, I choose sweep of 6 p.m. or either 10 p.m. 4-hour candle range high or low sweep, right? So you can be just looking for any other CRT or CRL as your own wish, but I would be choosing the 10 p.m. 4-hour candle for my London model. So part 2, introduction to SMT divergence, the high probability reversals. So this is the topic we use for high probability reversals. Now what is SMT divergence? So basically SMT divergence is a tool which is used by market makers to signal that the reversal is in the operation. It means if they were buying, now we can be watching the reversals towards sell side momentum, and if we are selling, then we'll be looking for the reversals towards buy side momentum, right? So now how does it work? So we have some of the examples, right? Like in that scenario, we'll look for correlated pairs. Example, GBP USD and Euro USD. You can be just looking for any correlated pairs, like you are looking for US 100 with US 500 and some of the other asset if you're wanting to go in detail, right? So they are correlated with each other. Let's understand it through examples, right? Let me just begin with the examples on chart. So this is the example number 1, XAU USD 5-minute chart. So you can see here on the chart we have shifted the market structure and we had the intermediate term high. We have taken out the intermediate term high there, right? This is the short term high this is the short-term high, which is this, right? But we have taken out, like this intermediate term high. This is the short-term high, sorry, intermediate term high on that side, and this is the short-term high we have taken out. So this is what we call the SMT divergence. So simply we'll be looking for two of the pairs in which we are taking out the low or high in one asset, and then we'll be looking for the another asset should have the swing failure. Now let me show you another example for the bullish one. So this is the US 100 chart, and there you can see US 500 chart. We have taken out we have the swing failure on NAS 100 or US 100, and we have failure swing on US 500. I just have wrote NAS 100, but it is US 500. Okay, should be keeping that in your mind. So this is what we call SMT divergence. So when we are looking for the high probable reversals, we will be always looking for two of the assets which are correlated, and we will be looking for the failure swings in which we are going to trade, because it would have high chances to go into your direction. So now, introduction to time and price, which is most important, you have to actually focus on and you have to apply into your trading journey. So now, introduction to time and price theory. What is basically time and price theory? So now, time is the first component IPTA will refer to. Now, what is IPTA? I've already created a video on it. I would be just keeping the link in the bio. You can be just watching it. So once the time window is in operation, IPTA will then look to see key levels, PD arrays, and price. It is always time and then price. We'll be always looking for time and we'll be then focusing on price. So what are the key time windows? We'll look forward to 6 p.m. and 10 p.m. as in key time windows for CRT and turtle slope entries. One must aware of ICD kill zones is for understanding algorithmic manipulation. Now, if you are not aware of algorithmic manipulation or the ICD kill zones, you basically need to go and learn about the ICD kill zones, because it is very important in that phase of the trading, right? Or in this model. So now we'll be talking about the entry models, which are compulsory in that model. So entry models, part 3, ICD 2022 model, which is a model based on reversals. So which is like based on the sweep of liquidity and an immediate reaction after it. One must wait for market structure shift and can use fair value gap as an entry. So now in 2022 model, we'll be just looking for fair value gaps after a structure shift, and we can be looking for also SMT divergence for high probable reversals, and then we'll be using 2022 model in that model, right? So unicorn model, which is based on breaker blocks, we use in markets in high probable scenarios. So now if you're looking for breaker blocks, I already created a video on breaker blocks, and you should be looking for market structure shift and then breaker blocks to actually enter from the breaker blocks, and you can be just putting a stop loss in any swing lows or highs, right? So the last part is putting it all together, and we'll be going through the examples of CRT, and also we'll be talking about my model and everything in that phase, right, or in that part, and you will be actually knowing how I actually trade it. So now chart example number 1. So there was a high time frame key level. We always be looking for high time frame key level. So there was the rejection block on high time frame, and we have this 10 p.m. candle range, low and high marked. So we'll be just waiting for either to high should be swept or the low should be swept. Then we'll be looking for the reversals, right? So this was basically the forward chart, and then we'll be going for the lower time frames like 3 minute, or you can be going for 5 minutes, and should be in kill zone windows, right? So this is the 2 a.m. which is the starting of London session, and we'll be looking for high to create after sweeping this high, or either to low to create after sweeping this low. So now you can see we have just this 10 p.m. CR-ish has been taken out. We have high time frame key level, and then we shifted market structure. We'll be entering from that fair value gap. We would be entering from that fair value gap, and we'll be looking for this candle range low to be taken out, right? So here we have entered into it. Let's see how it plays out. So we have actually took out the trade there, and we have played nice after taking out this candle range low. Let me show you another example. So this is the example number 2. We have 10 p.m. candle range low and candle range high. We'll be just looking for the either to take out the sell stops and go higher, or either take out the high and then come down lower, right? So this is the 3-minute chart. We have the high time frame key level and 10 p.m. candle range low. We shifted the structure, and there you can see the breaker block. I would be entering from that breaker block for safe place is our limit get executed, because most of the times price do not come into the fair value gaps. So I will be using this breaker block model, which is a unicorn model, right? So I've just put the trade there, and let's see how it plays out. So we have just hit into the fair value gap, and we have just nicely taken out the CR-ish candle range high.